Stop what you're doing. Because while everyone was distracted by metals, memes, and market headlines, a real switch just flipped in the darkest corner of global finance. Japan, the country that spent decades pretending interest rates didn't exist, is suddenly paying real yields again. That sounds boring until you understand what it really means. It's like ripping the power cord out of the global economy. Now, before we go any further, my YouTube analytics show a massive percentage of you watch every video but aren't subscribed. If you value this kind of breakdown, hit subscribe right now and drop a quick comment like ARJAG so the algorithm knows this matters. .br. Right, here's the setup. For years, Japan was the world's cheat code. If you wanted cheap money, you went to Japan. If you wanted to borrow at almost nothing, you went to Japan. If you wanted to run the carry trade, borrow yen and buy literally everything else, Japan was the fuel. And this wasn't just a Japan story. It was the invisible engine under stocks, crypto, real estate, venture capital, basically the entire everything bubble. And now that engine is stalling. The numbers don't look scary if you don't understand the context. A 10-year Japanese government bond yield in the low 2s, a 30-year pushing toward 4, a 40-year poking above 4. If you're in the US, you glance at that and shrug. You've seen higher yields before. But Japan isn't the US. Japan is the opposite of the US. Japan is where investors were trained to live with zero and even negative yields. In Japan, a move like this isn't a speed bump. It's a cracked axle at highway speed. And here's what most people miss. Japan isn't just another economy. Japan is the creditor country. Japan is the vault. Japan is the global savings machine that has been exporting capital for decades. When Japan earned nothing at home, its institutions were forced to hunt abroad. They bought foreign bonds. They bought foreign stocks. They bought us. Treasuries. They bought the paper that keeps the global system glued together. So when Japan's domestic yields rise, something dangerous happens. The incentive flips. The money no longer needs to leave. It can come home. And when money comes home, it doesn't tiptoe. It drags liquidity out of everything it touches. Picture global markets as a giant pool. For years, Japan was pouring water into it. Now the hose is off and the drain is open. At first, the water level barely moves. Then the shallow end starts acting strange. Then the deep end exposes what was hiding underneath. And eventually people realize the pool isn't low, it's emptying. This is why the bond market matters more than silver, more than Bitcoin, more than whatever trend is loud this week. Because the bond market is the funding market. It's the price of money. And when the price of money rises in the wrong place, at the wrong time, with the wrong debt load, you don't get volatility. You get forced selling. Japan's debt bird. Yen is enormous. With that level of debt, you can't tolerate higher rates like a normal country. Higher yields don't just hurt. They eat budgets. They consume tax revenue. They turn governments into debt service machines. That's why Japan spent years doing the unthinkable. Its central bank buying massive amounts of its own government bonds to keep yields pinned. It was policy, yes, but it was also a confession. Japan was admitting that if the market set the price of money, the math breaks. So what changed? The currency. For years, Japan could suppress yields and live with a weak yen, but a weak currency isn't free forever. A collapsing yen makes imports expensive. It makes energy expensive. It makes food expensive. It quietly squeezes everyday life. Eventually, a country faces an impossible choice: protect the bond market or protect the currency. Protect the bond market and you print and buy bonds, destroying the currency. Protect the currency and you stop printing, forcing the bond market to face reality. Japan is being pushed toward reality, and reality in a debt-heavy system looks like falling bond prices, rising yields, and balance sheets that suddenly don't work. Now here's why this reaches directly into your life, even if you've never touched a Japanese bond. Japanese institutions hold enormous amounts of foreign assets, not niche assets, the big ones. US government debt, US equities, the same mega-cap stocks sitting in your retirement account, the same indexes people feel safe owning because they've only gone up. Here's the pivot. If Japanese institutions can earn meaningful yield at home in their own currency without FX risk, the reason to hold foreign assets shrinks. And if they're also facing losses at home from falling bond prices, the pressure to raise cash increases. That's repatriation. And repatriation isn't a vibe. It's a flow. Let's slow this down. Rising yields mean falling bond prices. Japanese funds holding domestic bonds see they're safe. Assets lose value. That punches holes in balance sheets. When holes appear, they get patched. And the easiest patch is selling what's liquid and profitable. Often that's foreign equities, often that's US tech. Often it's the most crowded trade on earth. So the risk isn't that Japan slows. The risk is that Japanese capital exits global markets. And when a major holder becomes a seller, markets don't care about your narrative. They care about supply and demand. Now it gets worse, because it doesn't stop there. Enter the carry trade. For years, borrowing yen was basically free. Funds borrowed yen, swapped into dollars, and bought higher-yielding assets, stocks, junk credit, emerging markets, crypto, real estate, anything that could outrun a near-zero funding cost. But when Japanese yields rise and the yen strengthens or becomes expensive to borrow, that trade gets squeezed. And squeezes don't unwind politely. They liquidate. Not because managers want to, but because margin forces them to. That's why markets can fall violently with no obvious news. It's not irrational. It's plumbing. It's funding stress. It's leverage reversing. And this unwind feeds on itself. Yields rise. Funding tightens. Positions become risky. Assets get sold. Prices fall. Margin calls trigger. More selling follows. The loop reinforces itself. This is why this matters to everything. It's not one market. It's global liquidity reversing. For 15 years, liquidity saved everyone. A dip happened. Stimulus arrived. A crack formed. Rates were cut. But what happens when the crack is in the country supplying cheap funding? That country is Japan. This is why traders call Japanese bonds the widowmaker. For years, betting against Japan meant getting crushed as the central bank kept buying. But now the train is running out of track. The currency constraint is tightening. The market is calling the bluff. Where does this go? 3 paths. 1. Japan buys bonds again aggressively, stabilizing yields but crushing the Y. And 2. Japan allows yields to rise, accepting fiscal and balance sheet pain. 3. A messy hybrid, temporary fixes, slow drift upward. None of these lead back to easy money. That era is ending, not dramatically but mechanically. Through flows, now connect this to the US. Japan is one of the largest holders of US Treasuries. If Japan stops buying, auctions get harder. If Japan sells, yields rise. And when US yields rise, everything built on cheap financing starts wobbling. Housing, credit, banks, corporate debt. Here's the key question. If one of the biggest buyers steps away, who replaces them? That's the Fed's nightmare. Because with massive deficits and constant issuance, the bond market needs buyers. If foreign demand weakens and domestic demand can't fill the gap, only one buyer remains, the central bank. And when the central bank becomes buyer of last resort, you don't just stabilize markets, you debase the currency. That's the trade-off. That's the quiet tax. This is how hard asset re-enter the story, not because they're magical, but because they sit outside the promise-based system. Now I'm going to say something most creators won't. If your portfolio assumes permanently low rates, it's built on a regime that's ending. Long-duration growth stocks, long bonds, anything that needs cheap capital to justify valuations. When the cost of money rises, valuations compress. That's math. Japan changed the wind. What used to be a tailwind is now a headwind. And headwinds don't arrive in one crash candle. They show up as a grind, a slow squeeze on liquidity, a slow squeeze on leverage, a slow squeeze on valuations. The most exposed assets? Mega cap tech, the easiest to sell. Speculative assets dependent on liquidity. High beta sectors. Crypto, highly indebted real estate, fragile credit. And the hidden exposures, duration risk inside banks and money markets. This isn't a Tokyo headline. It's a global balance sheet event. Phase 1, Japanese yields rise. Yen shifts, carries TR. S begins. Phase 2, repatriation flows intensify. Selling pressure begins to surface in foreign assets. Phase 3 follows as US yields rise in response to shifting demand and domestic financial conditions tighten. Phase 4 is where policymakers step in. Intervention narratives return, printing re-enters the conversation, and hard assets reprice. That's the broad structure. The timing won't be clean, the path won't be smooth. But the logic holds. And if we're being honest, most people won't recognize it until Phase 3. Phase 1 gets dismissed as noise, Phase 2 gets labeled a rotation, then Phase 3 hits and suddenly everyone acts shocked. But it's not a shock. It's consequences arriving on schedule. Now, if you're still with me, we need to talk strategy. But before we do, a quick creative detour. If you're someone who enjoys silver-related success stories, real people, real journeys, step-by-step wealth building, there's another channel linked in the description. Go check out and subscribe. It's focused on motivation without hype. All right, strategy. In a world where bonds aren't safe, stocks aren't guaranteed, and cash quietly bleeds, the real question becomes this: what do you own that doesn't depend on someone else keeping a promise? That's the core issue. Because when leverage unwinds, the real damage isn't just price declines, it's counterparty risk. The fear isn't only that assets fall, it's whether the system settles at all. That's why during periods of real stress, people gravitate toward assets that don't require a clearinghouse to remain valuable. Now I'm going to outline a framework. This isn't financial advice. It's the map people use when regimes change. First, reduce exposure to long-duration risk if you don't fully understand it. Second, be extremely careful with leverage. In a liquidity reversal, leverage stops being a tool and becomes a weapon pointed back at you. Third, think about hard assets as insurance, not trades. Fourth, hold L. Liquidity informs you understand and trust. This is why gold and silver re-enter the discussion, not because they promise upside, but because they remove specific risks. You might say, but John Ag metals can be volatile too, and that's true. But volatility isn't the same as counterparty risk. A stock can fall and recover unless the company fails. A bond can fall and still pay unless inflation destroys its real value. But when systems freeze, the real question becomes settlement and trust. Hard assets bypass parts of that equation. Now here's the retention hook. The most dangerous part of this Japan story might not be stocks or bonds, it might be the fix. Because fixes come with costs, and those costs often show up as currency debasement. That's why silver and gold can rise even when markets feel unstable. Instability tends to trigger the exact policy responses hard assets benefit from. Timing matters, though. Early deleveraging phases usually hit risk assets hardest. Later phases oft ignite hard assets as printing accelerates. That's why people get confused when Bitcoin drops in a liquidity crunch while metals hold up better. It's about funding, not ideology. Now let me answer a question I know is coming. If Japan is under stress, why would the yen strengthen? The answer is flows. When yen-funded trades unwind, yen gets bought back. When foreign assets are sold and capital returns home, yen is purchased. So even with structural problems, the unwind itself can strengthen the currency in the short term. That strength tightens the squeeze and accelerates the unwind. It's counterintuitive, but it's real. Here's why understanding this gives you an edge. Markets don't move on headlines. Headlines chase markets. Markets move on marginal changes in funding, liquidity, and incentives. Japan isn't a marginal shift. It's the center moving. For decades, Japan anchored low global rates. When that anchor lifts, waves get larger, boats collide, and weak structures fail. So, do you watch next week, next month, next quarter? Watch Japanese long bond auctions and yield spikes. Watch yen trends and volatility. Watch U.S. Treasury demand and bid-to-cover ratios. Watch credit spreads and funding stress. Watch central bank balance sheets more than their words. Central banks sometimes mislead with language, but they tell the truth with actions. Now let's make this interactive. What do you think is the most fragile part of the system right now? Banks, housing, stocks, or government debt? And if you had to choose one asset for the next 12 months, what would it be? Drop it in the comments. And if you're in a good financial place right now, share your success story, even a few lines. It lifts the entire community and reminds people smart moves are still possible. Now we need to address the endgame scenarios, because preparing only for mild volatility misses the real risk. One path looks like this. Japan's bond stress spreads, U.S. yields rise, something breaks domes. Particularly, the Fed steps in, liquidity returns, inflation expectations rise, and hard assets surge. Another path is controlled pressure, supportive measures without full-scale printing, leading to slower growth, grinding markets, and persistent inflation. Either way, the easy world is over. Now let's talk about what nobody wants to say out loud, the 60/40 portfolio. For decades, investors believed stocks and bonds provided diversification. But in a world of sticky inflation and structurally higher rates, stocks and bonds can fall together. The hedge breaks. Correlations flip. That's why you need a third pillar, assets that don't behave like promises. Commodities and real assets fill that role, not as get-rich bets, but as structural diversifiers. Now we need to talk psychology because this is where people lose. Slow grind markets erode confidence. They make you chase small bounces and hold losers too long because nothing feels dramatic enough to force a decision. They make you ignore that. The environment has changed. The antidote is clarity. Know what you own and why. If you own stocks, understand rate sensitivity. If you own bonds, know duration and inflation risk. If you hold cash, understand inflation erosion. If you hold metals, accept volatility and time horizon. Here's another cliffhanger. We haven't even discussed what happens when Japanese institutions visibly trim U.S. equities. Because once that becomes obvious, sentiment shifts fast. Markets don't just react to selling. They react to the expectation of selling. People front-run the flow. Moves compress. Long grinds suddenly produce air pockets. That's where panic forms. So we're already there? My view is that we're in transition. Early stages. Warning signals are flashing, but the mainstream narrative hasn't caught up. That's the window where preparation is cheap. Later, preparation gets expensive. Now bring this back to everyday life. Higher yields mean higher borrowing costs. That hits businesses, layoffs, consumption, and politics. Politics feeds back into markets. This isn't isolated. It's the slow spread of tighter capital conditions. That's why saying Japan pulled the plug isn't dramatic. It's descriptive. To the skeptic, I hear you. People have called doom forever, and most were wrong because policymakers delayed consequences. But delay isn't cancellation. High debt lets you delay by sacrificing currency value, widening inequality, and deepening distortions. Japan is one of those distortions shifting shape. One of the clearest tells is when safe assets turn volatile. Japanese long bonds were considered safe. When safety swings, stress is present. I'm watching that closely. Before we wrap, a note for the community. By the time you see this, there should be a members-only video live with a full update and deeper analysis. Premium members get even more detail. If you want to stay ahead without chasing clips, that's the fastest way. Now let's land this with actionable thinking. In a Higa. Alright, higher volatility world, your mindset has to change. Stop asking what will moon. Start asking what survives. Stop chasing trends. Start evaluating counterparty risk. Stop buying every dip. Start asking whether liquidity is rising or falling. Liquidity is the tide. If Japan drains it, you want assets that float in shallow water. Those assets include hard assets, quality cash flow businesses with pricing power, energy and resource exposure tied to scarcity, and yes, a thoughtful allocation to metals if it fits your profile. This isn't about fear. It's about timing. Markets move first. Headlines come later. Why now? Because Japan's yields moving isn't a chart blip. It's a signal that a 30-year policy era is cracking. It's the global carry trade being questioned. It's the repricing of money itself. And when money reprices, everything reprices. Two final questions. If Japan keeps allowing yields to rise, do you think the Fed will be forced back into heavy bond buying? And if that pens, which moves faster? Gold, silver, or something else? Comment below. Subscribe if you haven't. It matters. Crises don't start with sirens. They start with strange moves in ignored places. Japan is one of those places. The plug is being pulled slowly. Liquidity is draining quietly. Early understanding gives you choice. Late understanding forces your hand. Japan isn't the headline. It's the switchboard. And the switches are moving.